Today, the RBA needs to hike higher and quickly. Hello again, it's Martin North from Digital Finance Analytics, one latest post covering finance and problem news with a distinctively Australian flavour. Well, writing in an opinion piece in the AFR, economist Warren Hogan says the RBA must get on with lifting interest rates. He says the balance of risks to the RBA's monetary policy has shifted significantly since the board last met in December. It is no longer a case of whether they have to go another 25 basis points or 50. It looks like the cash rate will need to rise by somewhere between 100 and 150 basis points before this cycle is done. Inflation is more broad-based than previously thought. The domestic economy is holding up to the initial waves of rate hikes, but most importantly, the global economic outlook has brightened. Australians are facing an economic environment of rapidly rising interest rates. Therefore, gone is the fear of a global recession that dominated the economic narrative late last year. China is reopening and could add significantly to global demand in 2023. Recession risks in the US and Europe have declined, and the latest US employment report highlights economic resilience and all but guarantees that the Fed funds rate will exceed 5% in the months ahead. The RBA has been able to increase interest rates at a slower pace than other central banks for three reasons. Firstly, the dominance of variable rate mortgages in Australia means that the interest rate changes should have a more immediate effect than in fixed rate markets. The pace of interest rate changes matters more in Australia than in the US, Canada or New Zealand. Ultimately, it is the level of interest rates that matter, specifically short-term real interest rates. Our variable rate mortgage market does not change macroeconomic fundamentals and the interest rate end game for Australia. It just means that we will take a little bit longer getting there, hence the early pivot from the RBA. There is nothing I can see in our economy that suggests our real interest rates should be 2% or even 1% below that of economies experiencing a similar quantum of inflation. The second point is our inflation has lagged global trends, but the fourth quarter CPI numbers have confirmed that we are getting just as much inflation as other similar economies, if not a bit more. And finally, the combination of the above has meant that the RBA board has had the very real possibility of a sharp global downturn doing something of the heavy lifting on slowing the domestic economy in 2023. The powerful reverse of global demand and the associated deflationary dynamic may have meant that the RBA could get inflation back to target with low interest rates than those in other countries. To be sure, a mild disinflation consistent with peak headline inflation is coming out of the global economy. The original pandemic inflation shock is now receding, but this will do very little to slow an economy now producing 5% to 6% domestic inflation. The IMF last week all but sealed the fate of this view with its upward revision to global economic growth in 2023. A major global economic slowdown is looking less likely. If anything, the global economy will be helping Australia in 2023. These are the key factors that motivated the RBA's pivot to 25 basis point hikes in October, well before other central banks began to lift their feet off the brakes. But the early pivot always came with the risk that the board may have to revert to 50 basis point hikes at some stage. The governor canvassed this issue in his excellent speech to CEDA's annual dinner last November. Good news on the global economy is actually bad news for Australian interest rates. Though other central banks are now signalling that a pause in the tightening cycle isn't far off, they have remained committed to fighting inflation right up until the last week. The Fed has finally achieved an important objective. With its latest rate hike, the nominal Fed funds rate at 4.75% is now higher than core inflation. The core PCI deflator was 4.4% in December. They finally achieved a positive short-term real interest rate. The RBA still has a long way to go on this metric. Our short-term real interest rate was minus 3.8% in December. Even if core inflation pulls back to 5%, as it's done in the US, we're still sitting on a negative real rate of almost 2%. We do not have an economic model or the economic precedent to show that we can get inflation under control with negative real interest rates. Over the last months of 2022, the narrative about Australia's monetary policy and the economy has been dominated by a fear that higher interest rates will tumble the economy into a damaging recession. Little attention has been paid to the risk that the economy, far from tumbling into recession, actually bounces back after adjusting to the initial series of rate hikes. ANZ CEO Shane Elliott noted in a speech last week in Adelaide that not only are mortgage arrears the lowest in history, but those borrowers who have rolled off fixed rates onto a variable in recent months are in a better financial position than the average. His conclusion: interest rates will need to go higher than the market expects. And he says, I expect the RBA board to discuss a 50 basis point rate hike at its meeting on Tuesday. If the board thinks rates need to get towards 4% in early 2023, then it should get on with it and increase the cash rate to at least 3.5% this week. Now, I think there's a lot of truth to this insofar that we know the RBA is behind the eight ball, but of course they're also acutely aware of the debt issues in Australia. We have high household debt. And whilst I agree that on average things may be okay, it's the marginal borrower which is the real concern. We're certainly in our surveys seeing more households that are actually closer to the edge, and quite a few of those took a loan out relatively recently, bought at the peak, and are now experiencing both rises in their monthly repayments, which will increase ahead, of course, and also falling property values. Now, the question is, will the RBA be influenced by this factor, or will they stick to their deadly inflation-beating game? Well, we'll know tomorrow, of course, and we'll be discussing this whole issue in a live stream on Tuesday evening at 8 p.m. Sydney time, when we'll also be discussing the latest from our mortgage stress survey. So mark your diaries and join us then. This is Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.